Now, back live with Chris Kenny.
Of course, the big story last week was the Banking Royal Commission, and a lot of people expected it to focus pretty heavily on separating financial advice from financial products. But the Royal Commission didn't go as far as many people thought it would when it came to the banks and their financial planning arms. But in a similar area, in a similar vein, it's actually gone much further than people expected when it comes to the mortgage broking industry and making sure that they actually charge for a fee for service rather than rely on bank commissions. There are going to be big implications from this. I'm joined on set now by Mike Felton from the Mortgage and Finance Association of Australia. Thanks for joining us, Mike.
Thank you, Chris.
This is a big surprise. You knew something was coming, but this is really an outright attack on your business model, which is mortgage brokers who actually earn their living by the commissions they get from the banks and other financial institutions whose products they on-sell to people.
Absolutely. It's also an attack on consumers because they're going to be worse off at the end of the day. The recommendations have handed a huge win to the banks. You're not only going to have the consumer paying the broker going forward rather than the banks and lenders, but you're also potentially going to have a multi-$1,000 fee from every customer going into a branch in order to ensure there's a level playing field. Now, whichever way you look at it, that is effectively a multi-$1,000 tax on borrowing and has the potential to devastate the mortgage broking industry, which will reduce competition and choice, further reduce access to credit and hand power back to the majors, making it harder and more expensive to get a home loan.
Well, let's go back to first principles. We can understand, surely you can understand, why this model is seen as a problem. If I go to a mortgage broker and that broker is actually paid by the banks, then there's a question about whose interests the broker is going to be served. Are they serving my interests or those of the banks? So there's an inherent problem or conflict in that relationship, right? How do you deal with that?
There is, and depending on your industry, you don't necessarily have to deal with it, you just have to manage it. Now, our industry has been through a significant amount of reform over the past 18 months to address these conflicts. We've removed volume bonuses. We only now pay the broker based on drawn down amount net of offset. So if that broker was encouraging somebody to borrow more than they needed, that money goes into the offset account and the broker gets nothing for that additional funds. It has addressed the conflict. And in fact, Treasury said that blanket bans on conflicted remuneration for intermediaries are not the right answer. They made that in their submission to the Royal Commission interim report back in October. That was ignored, as was the Productivity Commission's statement in their final report that a consumer fee for service would come at a high cost to competition and result in customers deserting mortgage brokers.
I've got to say, from my own personal experience, I first used a mortgage broker about 7 or 8 years ago. I was suspicious about the process, knowing that they're paid by the banks, but on questioning the person you're dealing with and looking at the range of policy of product options they put before you and trying to cater to your needs, you can pretty quickly ascertain whether you're dealing with someone who's got that knowledge and breadth of products available. I found it enormously valuable. But of course, there'll be shonks. And you need to always be on the lookout for shonks.
There will be. A broker's got, according to Deloitte Access Economics, 13.8 years industry experience and on average has access to 34 lenders. That really does give them the ability to work through the complexity of the current market, but which is particularly tight from a credit perspective. Brokers have played a significant role in keeping credit flowing by redistributing that credit demand that banks have been turning away following the Royal Commission. And yes, every industry has misconduct. Our industry has worked really hard to improve its disclosure, to address those conflicts, and we are working on a significant enhancement of our governance framework, which will use data to proactively monitor those brokers and an industry code to enforce the reforms that we have delivered.
What's the real problem with a fee up front? Is it just that it might dissuade customers from using brokers? What sort of a fee might you be looking at, say, for a $500,000 mortgage? And do you think that would dissuade people from using brokers?
You're looking at about $2,500, $2,500 to $3,000 up front, and the same an equivalent of that over the life of the loan in total. We have research, there's extensive research done, that Australians don't like paying fees. And in fact, the research was on mortgage brokers, 5,800 existing mortgage broker customers. that said 60% of them would pay zero and only 3.5% of customers would pay the fee of $2,000 or more. That tells you the Productivity Commission was right. They will desert the mortgage broker.
This is the problem. If they do desert, if that fee does dissuade people from using brokers, and if most brokers are good and honest and know their job and they help people look at the different products, look at the different rates, structure their mortgage appropriately, obviously they're helping people through a very complex area and they're adding value to customers and protection to customers. If you get rid of mortgage brokers, if out of the system, it's likely not only to strengthen the hand of the big banks, but actually limit consumer options.
Absolutely. Mortgage brokers over the past 20 years have been responsible in part for a 3 percentage point decline in net interest margin as they've driven competition. If you take brokers out of the equation, those numerous hundreds of lenders that sit below the big four have no shop front, those that have no branch network. If they do not have the ability to offer product and customers' access to those lenders is restricted, you really are forcing the customers back into the branch, and that will simply hand power back, making it more expensive and harder.
Oh, it's going to be an interesting one to watch, and I think one that's going to have a big impact on a lot of customers. Thanks for joining us, Mike.
Thank you so much.
Mike Felton there. I should point out, actually, I just noticed a television ad on this network today making some of the political points there on behalf of the Mortgage and Finance Association of Australia. Point out, I've never met Mike before, and I rang him and organised this interview last Wednesday or Thursday when I thought it would be an issue, so nothing linked to those ads. I'm going to take a break now. I'm going to check in on the New South Wales election. What are the federal ramifications of this New South Wales election? The campaign is in full swing just at the moment, and also find out a little bit more about the New South Wales Liberal Premier Gladys Berejiklian. A bit of an enigma is Gladys, I think. Andrew Clennell next.
You're watching Kenny on Sunday on Sky News Live.